60 days ago, my credit score was 618. Today, it's 745. That's a 127-point jump in 2 months. Same person, same income, same payment history. The only thing that changed was my understanding of how credit scores actually work. That 127-point increase will save me approximately $180,000 in interest over my lifetime. On mortgages, car loans, credit cards, everything. Same life, different knowledge, 6 figures in savings. Here's what makes this particularly interesting. I didn't pay off debt. I didn't dispute inaccurate information. I didn't wait years for my history to age naturally. I used a mechanism built into the credit scoring system that banks understand perfectly but have zero incentive to explain to customers. Today, I'm going to show you exactly what I did. By the end of this video, you'll understand why everything you've been told about building credit slowly over time is technically accurate, but practically incomplete. There's a faster legal path that the system allows, but nobody advertises. Let me start with the method itself, then I'll explain why it works and how you can use it. The primary strategy is called authorized user tradelines. Here's how it works in simple terms. When someone adds you as an authorized user on their credit card, that card's entire history appears on your credit report. Not just from the moment you're added, the complete history from when the account was originally opened. The account age, the payment history, the credit limit, and the utilization all get imported to your credit file as if you'd been part of that account since day one. If your parent has a credit card opened 18 years ago with perfect payment history and a $30,000 limit, and they add you as an authorized user today, an 18-year-old account with perfect history appears on your credit report within 1 to 2 billing cycles. Your average account age could jump from 3 years to 10 years overnight. Your total available credit could double or triple. Your payment history could extend back decades. This is exactly what I did. I had 3 credit cards with a combined history of 5 years. My mother had 2 cards with a combined age of 34 years, perfect payment history, and total limits over $45,000 with utilization under 8%. She added me as an authorized user on both accounts. Within 6 weeks, my credit report showed 2 additional accounts with 19 and 15 years of perfect history. My average account age went from 5 years to nearly 12 years. My available credit increased by $45,000. My credit score jumped 127 points. The authorized user never needs to receive a physical card. They don't need account access. The addition is purely for credit reporting purposes. My mother added me through her online banking portal. It took about 8 minutes total. Now let me explain why this works and why it's completely legal. Credit scores are statistical predictions of default risk over the next 24 months. The algorithm examines your credit behavior and compares it to patterns from millions of other consumers. It identifies factors correlated with reliable payment and factors correlated with default. The largest factor is payment history, roughly 35% of your score. The second largest is credit utilization, roughly 30%. The third largest is length of credit history, roughly 15%. Most people assume length of credit history is simply a function of time. You opened your first card at 20, you're now 28, so you have 8 years of history. Nothing to accelerate, just wait. But that assumption contains a critical error. Your credit history length isn't determined by when you personally first borrowed money. It's determined by the age of the accounts on your credit report. When you become an authorized user, the account's age becomes part of your report. The system doesn't distinguish between primary cardholders and authorized users for credit reporting purposes. Both get the benefit of the account's history. This isn't a loophole in the sense of exploiting a glitch. This is a designed feature of the credit reporting system. The Fair Credit Reporting Act explicitly allows authorized user accounts to appear on credit reports. Credit bureaus have known about this for decades. It's working exactly as the system was built to work. Banks know about authorized user strategies. They simply have no incentive to tell you. Every month you spend with a fair or good credit score instead of excellent costs you money in higher interest rates. That money becomes their profit. They benefit from you not knowing how to escape that tier quickly. Before I give you another example, let me show you the actual financial impact of different credit score ranges with real numbers. This is what the difference between a 620 score and a 750 score actually costs you. On a $350,000 mortgage with a 30-year fixed rate, a borrower with a 620 score might get quoted 7.2% interest. A borrower with a 750 score gets quoted 6.1% for the same loan, same house, same down payment. That 1.1 percentage point difference costs the first borrower an additional $87,000 in interest over the life of the loan. Same house, same income, different knowledge about credit optimization. $87,000 in additional costs. On a $28,000 car loan over 6 years, a 620 score gets quoted around 11% interest. A 750 score gets quoted around 5%. The difference is $5,200 in additional interest for the lower score borrower. Credit cards typically reserve their best products for scores above 740. The difference between premium cards with 2% cash back and no annual fee versus standard cards with 1% cash back and fees might seem small, but over decades of spending, it compounds to thousands in lost rewards and paid fees. Insurance companies in most states use credit-based insurance scores to set premiums. The difference between good credit and poor credit can mean $400 to $800 more per year in auto insurance for the exact same coverage and driving record. Add it all up across a lifetime: mortgage, car loans, credit cards, insurance, personal loans. The total cost of a 620 score versus a 750 score easily exceeds $200,000 for most Americans. That's not an exaggeration, that's arithmetic. This is why the strategies I'm showing you matter so much. This isn't about gaming a system for no reason. This is about avoiding a tax of 6 figures over your lifetime that you're only paying because of incomplete information. Now, let me give you a concrete example of how this works for someone else. A 26-year-old named James had a credit score of 597. He'd made some mistakes in college, missed a few payments on a store card, and carried high balances for several months. He was trying to finance a car, and every offer he received had interest rates above 13%. His grandfather had 2 credit cards dating back to 1991 and 1998. Combined limits over $52,000, utilization consistently under 5%, 0 missed payments in 33 years. His grandfather added James as an authorized user on both accounts. He never gave James physical cards or account access. The addition was purely for credit reporting. Within 75 days, James's credit report showed 2 accounts with 33 and 25 years of perfect payment history. His average account age went from 4 years to 18 years. His available credit quadrupled. His score increased to 681. That crossed the threshold for reasonable auto financing. Instead of 13% interest, he qualified for 7% on a $22,000 car loan over 5 years. The difference saved him approximately $3,600 in total interest. His grandfather's 10-minute action transferred $3,600 of value instantly. Now, let me walk you through 3 additional strategies that work in combination with authorized user trade lines. Strategy 2. Utilization timing manipulation. Credit card companies report your balance to credit bureaus once per month, typically on your statement closing date. The balance reported on that specific day becomes your utilization for the next 30 days. Most people pay their bill when it's due, which is usually 21 to 25 days after the statement closes. But by that time, the high balance has already been reported. Instead, pay down your balance to near zero a few days before your statement closing date. Let the low balance get reported. Then use the card normally afterward. This allows you to use credit throughout the month while showing minimal utilization on your credit report. You're not changing your spending, you're just changing when you make payments to optimize what gets reported. I reduced my utilization from 28% to 4% using this method. My balance didn't actually change much month to month. I just shifted when I made payments to ensure low balances were reported. Strategy 3. Strategic credit limit increases. Request credit limit increases on all existing cards every 6 to 8 months. Most issuers allow online requests that don't trigger hard inquiries. Higher limits with the same spending automatically reduce your utilization percentage. If you have a $5,000 limit and carry a $1,200 balance, that's 24% utilization. If you increase the limit to $10,000 and maintain the same $1,200 balance, utilization drops to 12%. Same spending, better score. I requested increases on 3 cards within 2 months. 2 approved immediately with no hard pull. Combined limit increases of $7,800. My utilization percentage dropped even though my actual dollar spending stayed constant. Strategy 4. The smaller accounts closure decision. Most advice says never close credit cards because it reduces your available credit and average account age. But this isn't always correct. If you have a new card that's dragging down your average account age and you're not using it, closing it might actually help if you have enough other older accounts. I had a store card opened 14 months prior that I'd used once. It was reducing my average account age and providing minimal credit limit. After being added as an authorized user on my mother's cards, I closed the store card. My average account age actually increased because removing the young account made the calculation favor my older accounts more heavily. This only works if you have older accounts established. Don't close your oldest card, but strategically closing your newest, least useful card can sometimes optimize your profile. Now here's the critical part most people miss. These strategies work exponentially better when combined rather than used individually. Becoming an authorized user adds old accounts and increases total credit. That sets the foundation. Then, optimizing utilization timing ensures low reported balances. Then, requesting limit increases further improves utilization ratios. Then, strategically closing the newest weak account optimizes average age. Each step compounds the previous step. The combined effect is dramatically larger than any single strategy alone. When I combined all 4 approaches over 60 days, the result was that 127-point increase. If I'd only done authorized user status, the increase would have been roughly 80 points. The additional strategies added another 47 points on top. Let me address the 3 most common mistakes that sabotage these strategies. Mistake 1. Choosing the wrong authorized user account. Not all accounts help equally. An account with high utilization hurts rather than helps. An account with any missed payments in its history imports those negatives alongside the positives. An account that's only 4 years old provides minimal benefit if you already have accounts that age. The ideal account is old, has perfect payment history, has high limits, and consistently low utilization under 10%. Verify these factors before being added. Don't assume. Ask to see statements or credit reports showing the account details. Mistake 2. Applying for new credit while optimizing. Each hard inquiry temporarily reduces your score by roughly 5 to 8 points. Opening a new account reduces your average account age. People often undermine their optimization by simultaneously applying for cards or loans that work against them. Pause all new credit applications during your optimization period. Let your score increase first. Then apply for what you need from a position of strength with a higher score. Mistake 3. Inconsistent utilization management. Paying before the statement close works only if you do it every single month without fail. 1 month of forgetting and letting a high balance report can erase weeks of careful optimization. Set calendar alerts for 3 days before each statement closing date. Automate this if possible. Consistency is critical. Now, let me give you a specific 90-day implementation roadmap. Days 1 through 7. Identify potential authorized user accounts. These are typically parents, grandparents, or very close family members with long credit histories. Request to see their credit card statements or credit reports to verify account age, limits, payment history, and utilization. Select 1 to 3 accounts that are at least 10 years old with perfect history and utilization under 10%. Days 8 through 14. Request to be added as an authorized user. This usually happens through online banking portals or customer service calls. Confirm with the primary cardholder that they're not required to give you a physical card or account access. This is purely for credit reporting. Days 15 through 45. Wait for the accounts to appear on your credit reports. This typically takes 1 to 2 billing cycles. Check your reports from all 3 bureaus to confirm the accounts have been added with their full history. Days 46 through 60. Implement utilization timing optimization. Calculate your statement closing dates for all cards. Set calendar reminders for 3 days before each closing date. Pay balances down to under 5% before the closing date. Let the low balance get reported. Days 61 through 75. Request credit limit increases on all existing cards. Use online request systems to avoid hard inquiries. Aim for increases of 30 to 50% on each card. Even if only some approve, your total available credit increases. Days 76 through 90. Pull updated credit reports and check scores. Evaluate whether closing any new, low-limit accounts would improve average age. If you have accounts under 2 years old that provide minimal benefit, consider closing them strategically. This 90-day timeline works because it sequences the strategies for maximum compound effect. Authorized user accounts establish the foundation of age and limits. Then, utilization optimization and limit increases leverage that foundation for additional gains. Now, let me address a question many people have at this point. What if you don't have family members with long, perfect credit histories willing to add you as an authorized user? This is a legitimate obstacle for some people. Not everyone has access to parents or grandparents with decades of excellent credit. If that's your situation, here's the alternative path. Focus intensively on the strategies you can control directly. Utilization timing becomes even more critical. Get your reported utilization under 5% on all cards by paying before statement close dates. This alone can add 40 to 60 points to your score within 2 months. Aggressively request credit limit increases every 6 months. Even small increases compound. A $500 increase on 3 cards gives you $1,500 more total credit, which improves your utilization ratio if spending stays constant. Consider becoming an authorized user on a friend's account if you have someone you deeply trust who trusts you equally. This is less common than family arrangements, but it works identically from a credit reporting perspective. The key is finding someone with an old account, perfect history, and low utilization who's willing to add you without giving you account access. There are also services that facilitate authorized user tradelines for a fee. These connect people with good credit who are willing to add strangers as authorized users in exchange for payment. I don't recommend this route for most people because it's expensive, ranging from $400 to $1,200 per tradeline, depending on the account age and limit. But it exists as an option if you're optimizing for a specific time-sensitive goal, like a mortgage application. The most important thing to understand is that while authorized user status provides the fastest results, the other strategies still work and compound over time. Someone without access to authorized user accounts who optimizes utilization, increases limits, and manages their existing accounts strategically can still see 60 to 80-point increases over 6 months. It's slower than the combined approach, but it still works far faster than the conventional advice of just waiting years for your history to age naturally. Here's what nobody in the banking industry wants you to understand. The credit scoring system was designed by lenders to assess risk for lenders. It wasn't designed to help you optimize your financial life. It was designed to help banks decide how much to charge you. The system reveals certain information and obscures other information in ways that serve institutional interests over consumer interests. Banks don't explain authorized user strategies because helping you escape high-interest products faster reduces their revenue. Credit bureaus don't advertise utilization timing because complexity keeps consumers dependent on credit monitoring services that generate subscription fees. The entire industry benefits from people believing credit improvement is slow, mysterious, and requires professional help or patience. The reality is simpler. Credit scoring follows mechanical rules. Those rules are knowable. Once you know them, you can optimize around them. The gap between people who understand these mechanisms and people who don't translates directly into wealth over time. Someone who maintains a 760 score instead of a 660 score will pay dramatically less interest across their lifetime. Lower mortgage rates, lower auto loan rates, better credit card terms, reduced insurance premiums in many states. The savings compound over decades into six figures. These strategies work because you're operating within the system's actual design rather than the simplified version marketed to consumers. You're not cheating. You're not exploiting glitches. You're simply using features that exist by design but aren't publicized by institutions that profit from your ignorance. My 127-point increase in 60 days changed my financial trajectory permanently. The approximately $180,000 I'll save on interest over my lifetime will fund major life goals. The knowledge applies to every credit decision I'll make going forward. That same knowledge is now available to you. The system isn't hidden because it's illegal or unethical. It's hidden because nobody with a profit motive benefits from you knowing it. Now you know. What you do with that information determines everything.